Something doesn't add up when the same bank that once warned crypto opens the door to bad actors, suddenly publishes a report defending the exact law that regulates it. You're watching Coin Crusader, and that contradiction is exactly where today's story begins. For years, JPMorgan's leadership has been cautious in public about digital assets, even skeptical at times. But this week, the bank put out a written statement supporting the Clarity Act, the legislation that would finally give the United States clear rules for digital assets. That shift alone is worth pausing on. In its report, JPMorgan argued that defined rules around tokenization and programmable money could shorten settlement times and remove friction from how money moves. The bank specifically pointed to efficiencies that benefit both businesses and everyday consumers as commerce becomes more global and operates continuously. But here's where it gets more interesting. JPMorgan didn't just offer vague support. The bank said new legislation needs to close regulatory gaps rather than create new ones. And it wants crypto platforms held to standards similar to exchanges and brokerages, with real safeguards around stablecoins and anti-money laundering enforcement. That's a notably specific position for an institution that has historically kept its distance from this industry. And it raises a question most coverage is skipping over. Why would a bank this size publicly back a framework that increases its own regulatory exposure? One possible answer is that the framework isn't really a threat to firms like JPMorgan. It's a structure they helped influence, designed to formalize an industry they're already building inside of. That's a very different story than the one usually told about banks resisting crypto. This is only one piece of what's happening right now, though. While JPMorgan was publishing its position, regulatory developments in Europe were unfolding in parallel, and they tied directly back to Ripple. Ripple recently became one of a small group of firms, roughly 240 in total, authorized to offer crypto payment services across the European Union under the bloc's new licensing framework. For context, thousands of other firms didn't make the cut and have been pushed out of the market entirely as the rules tighten. That detail matters more than it might seem at first. A licensing process that eliminates the vast majority of competitors isn't a minor compliance update. It's a filtering mechanism, and Ripple came out the other side of it as one of the companies still standing. Put those two stories together, and a pattern starts to form. In the US, a major bank is publicly endorsing clearer digital asset rules. In Europe, regulators have already separated the firms built to last from the ones that weren't. Ripple appears on the right side of both situations. There's a third thread worth pulling on too. Reports have surfaced that financial infrastructure providers, including the Depository Trust and Clearing Corporation, are preparing pilot programs to move trillions of dollars in traditional assets like stocks and bonds onto blockchain-based settlement systems. That kind of pilot doesn't happen on a whim. It requires months of internal planning before anyone announces it publicly. So the timing becomes the real question. If institutions are quietly testing blockchain settlement infrastructure, while a major bank simultaneously throws its support behind the law that would govern it, that's not a coincidence worth dismissing. It looks more like preparation. Now, it's worth being careful here because preparation isn't the same as certainty. The Clarity Act still has to move through the legislative process, and timelines for U.S. legislation have a way of slipping. Optimistic predictions about a bill landing on a president's desk by a certain date have a poor track record across this industry. What can be said with more confidence is that the infrastructure conversation has changed. A year ago, discussions about tokenized settlement and programmable money were mostly theoretical. Now they're showing up in bank reports and pilot program announcements from the institutions that actually move global capital. For XRP specifically, the relevance comes down to function rather than hype. Ripple's network was built around fast, low-cost settlement between different forms of value, which is precisely the kind of bridging that tokenized asset markets would need if they scale the way these reports suggest. That doesn't guarantee adoption, but it does explain why Ripple's regulatory wins keep getting attention. There's also a market structure angle that doesn't get enough discussion. Clearer regulation tends to separate assets with genuine utility from those sustained mostly by speculation and thin trading volume. If that separation happens at scale, The assets tied to real settlement use cases are the ones positioned to benefit, while projects without a functional purpose face a much harder path to survival. So where does that leave investors watching this unfold? Probably watching three things over the coming weeks: whether the Clarity Act actually advances through Congress, whether additional banks follow JPMorgan's lead in public statements, and whether pilot programs like the one reportedly being prepared by the DTCC move from testing into anything resembling production use. None of those three things are confirmed outcomes yet. They're signals, not guarantees. And the distance between a pilot program and a fully operational system is usually much longer than headlines suggest. What is confirmed is that the institutions least likely to move early are now the ones publicly aligning themselves with this regulatory direction. That alone is a meaningful shift from where this conversation stood even 12 months ago. The real story here may not be the JPMorgan statement itself. The real story is whether this marks the beginning of institutional alignment turning into institutional action, or whether it stays exactly where it is right now, a well-written report sitting in Washington, waiting on a vote that hasn't happened yet.